welcome to Sectors Up Close. I'm Elena Casas. Our topic today is the turmoil in oil markets and its impact on the energy sector. And our guest is Ethan Devitt, the Chief Investment Officer at Moneta. Well, the war in Ukraine and the subsequent barrage of sanctions on Russia have sparked panic in global energy markets. A short while ago, the United States went ahead with announcing a unilateral ban on Russian oil imports. But even before then, the invasion saw the price of international Brent surge. It's up 60% this year alone. This has resulted in major gains for investors in the oil and gas sector. The S&P 500 Energy Index includes not only oil majors such as Exxon, but shale producers such as Hess. It's up nearly 37% over the same time frame. In addition to the sudden spike in prices caused by the invasion, there are a number of other factors at play. Global demand has recovered to pre-pandemic levels, but the OPEC Plus grouping, which includes Russia, has stuck to plans to gradually restore output much later this year. Some OPEC members have struggled to meet their own targets due to maintenance and other backlogs, while the industry as a whole has been reluctant to invest the huge sums required to develop new supply amid rising global pressure to move away from fossil fuels. Well, for more on this, I'm now joined by Moneta's CIO, Ethan Devitt. Ethan, hi. We've seen quite a dramatic market reaction to the news coming out of Ukraine. But what is the real risk that this could spark a 1970s-style oil shock?
I think you used the term panic earlier, and we're definitely seeing that markets are in panic. I sort of think it's the equivalent of the toilet paper rush and hoarding that we saw at the beginning of the pandemic. There was a sense that there would be a shortage. We didn't know how long the situation is going to exist for. The only thing that's different there is that the prices didn't adjust. It's not as efficient a market as we're seeing here. But we also have to remember that there is a precedent for demand destruction at a certain level. There is a point at which people start to use less oil, drive less, perhaps consume less, or perhaps they're just simply not buying from Russia, but they've bought elsewhere. So because of that, that naturally is a correction that might actually cause prices to fall. And remember, we do have alternative sources as well. We're coming out of the winter in Europe and the US, so we're coming out of the time when we need the most energy sources. So there could well be a moderating of the demand at that stage.
Do you think then that the price is unlikely to hold at this level for very long?
It could certainly hold for some time, but what we're seeing in the curve for oil in terms of the futures pricing is what's called backwardation, whereby so the price in the future is lower than the price today. And there's even a form of super backwardation, which is reflecting the very high price today not being matched by the price in the future. So this suggests that most of traders would expect that in the future we won't see these demands, the prices will moderate, will come down. And that's even the same estimate that we're seeing similar to the yield curve around interest rate and around inflation. So what we're seeing now is certainly a spike that's driven by this geopolitical uncertainty and shock. I don't expect it to persist. Even looking at the history of oil prices, they never persist. There is a volatility, and we can certainly expect volatility going forward, but not to persist at these very high levels for very long.
If we talk about the energy sector then, has your view on it changed since the Russian invasion of Ukraine?
Certainly it was. The macro factors around the energy sector were certainly more like headwinds than tailwinds, in that those headwinds were the demand for an energy transition, a growing demand from institutional investors to divest from fossil fuels, and a focus on renewable energy. And that was creating issues for the very large players. They now have seen certainly a tailwind in the form of the current demand and the price spiking. They're seeing super normal profits in some ways. And certainly being exposed to energy would have been a very profitable trade. It's very much an old economy type feel we're having in markets at the moment, even the Cold War symptoms, and sanctions and all of the rest. So for that reason, I certainly do think that the energy sector is looking more complex and more interesting today, but it does bode well for all sources of energy. And we will need to look to renewable energy because that is where the long-term trajectory is heading.
But you said it though, ESG pressure on market players has reduced investment in the oil sector in recent decades, and you could perhaps argue that underinvestment in the sector is part of the reason we're seeing a spike now. Do you think that trajectory is going to change direction and we'll see more investment in oil in the US?
I think in the short term, we will see more demands for drilling. We've seen that coming from all sources, all pundits asking for that. And that probably is in a response to the perceived shortage and the panic and just the spike and perhaps a call to action that we're seeing today. We've seen even the emergency purchases of oil by Shell, supposedly from at lower prices, because there was no alternative. So there is certainly, we're still in the winter season. There's still a demand to keep factories running and to keep houses heated. So for that reason, there could well be a demand, and that changes the dynamics. I don't think that's going to change in the long run. We very much know where this is heading in the long run, and there will need to be a concerted focus by all players in the energy industry towards an energy transition.
How would you advise investors to approach the energy markets in what is a very complex situation?
We always advise to be diversified, certainly across all equity sectors. We suggest broad diversification, rebalancing back, and overall having a core exposure, so not too much exposure to growth or value. Within the energy sector too, we like exposure not just to the energy itself, but also to the spokes, the railway lines, the providers, the infrastructure behind that. We very much do like infrastructure as an investment. We think it presents a very good inflation hedge. Commodities were traditionally thought of as being an inflation hedge, and certainly they're behaving like that today. In fact, they are their main source of inflation. But as a reliable inflation hedge in a portfolio, we don't believe that they stand up. So infrastructure sector is ultimately, it will be driven and will actually benefit from high energy prices. So we do think that that is a good solid place to have value and defensive exposure in a portfolio today.
Thank you so much for that insight, Aoifinn Devitt, Chief Investment Officer of Moneta. Well, before I go, here are some of the top stories in this space. Oil major Shell says it stopped buying Russian crude and said it will phase out all its involvement in Russian hydrocarbons from oil to natural gas over Ukraine. It's one of the first Western oil majors to abandon Russia entirely. Shell also apologised for buying Russian crude last week, even after it said it would pull out of its Russian operations, including an LNG plant operated by Gazprom, in which Shell owns a 27.5% stake. The company said the supply change would take weeks to complete and would lead to reduced output from some of its refineries. The European Commission has published plans to cut EU dependency on Russian gas by 2/3 this year and end its reliance on Russian supplies of the fuel, quote, well before 2030. EU executives said it would do so by switching to alternative supplies and switching to clean energy faster than planned. The task of weaning Europe off of Russian fossil fuels won't be an easy one. It buys about 45% of its imported gas from Russia, 1/3 of its oil and half of its coal. Russia on Monday warned Western sanctions on Russian oil could prompt it to close the major gas pipeline to Germany. Europe does have enough gas in storage to make it through the winter, but analysts say a prolonged shutdown would hit the European economy and cause factory closures. And global energy-related emissions of CO2 rose to their highest level on record last year. This, according to the International Energy Agency. Global emissions from energy rose 6% to a record 36.3 billion tonnes as economies recovered from the pandemic and the use of coal increased. China was the largest driver of the rise in emissions, while surging gas prices in Europe and the US made it more profitable for power generators to burn coal, which emits double the amount of CO2 as gas. And that's your roundup of the oil sector. I'm Elena Casas, and this is Reuters.